All right, thank you everybody for joining us today for this webinar covering the Trump and Harris take on taxes, their proposal on taxes. I am joined today by my associate and fellow advisor, Scott Barnes. Scott, thanks for being here with me today.
Yeah, it's great to be here. Really looking forward to going through this topic with everybody and answering some questions and hopefully uh, taking care of folks and getting them a better understanding of where things stand with the possible tax proposals and where everything else lands.
Absolutely. It's no doubt a timely topic, so let's get into it. One thing to mention is please make sure to subscribe to our YouTube channel. That is where the recording of this webinar will be posted, as well as additional video content covering timely topics that we're frequently posting as well. So make sure to go to YouTube. You can search Hapanowitz or Seasons of Wealth and click that subscribe button. All right, so taxes are not the only thing we will be covering today. We're going to be first giving you a brief overview of what the markets are doing and what they have been doing in this election year so far. And then we're going to try to draw some perspective and talk about how the markets typically act in prior election years, but also draw comparisons of how the markets typically react to one party over another being in office. And then we will get into the particulars of the proposals of each candidate, of both Trump and Harris. We'll discuss the Tax Cuts and Jobs Act and things to think about in anticipation of a potential sunset at the end of 2025. We'll review how different income sources that a typical retiree sees in retirement, how those are taxed, and compare and contrast those types of taxation. And at the end, we'll review some do's and don'ts to consider in light of everything we covered today. There are a couple questions that were submitted to us that we will cover at the end as well. So let's dive into it. Scott, it's been a hectic year, to say the least.
Yes.
Why don't you talk to us about what's happened so far this year in the world and the economy, and then we'll get into the markets.
Yeah, overall, obviously, since this is an election year, we'll focus a little bit on at the beginning here on sort of the craziness that's happened already. In July, we saw the attempted assassination of President Trump, and in September, we saw an attempted assassination prevented, which is all very good things. We don't want to see any of that type of thing happen. During the middle of that, we saw President Biden deciding to drop out of the race, and Kamala Harris, Vice President Harris, taking on the candidacy of for president of the Democratic Party. So those were big changes and sort of earth-moving type of changes that we've seen on the political front this year. On top of that, we continue to see rising tensions in Ukraine. We have the escalating war in Israel, which is now pulled in Lebanon and Iran. We also are seeing just across the board just unrest in most of the Middle East, and there's continued concerns there. On sort of the positive side of things for the economy, after basically from March of 2022 through mid 2023, the Federal Reserve had increased interest rates by over 5%. In September of this year, they went ahead and started their easing. And in September, they lowered the interest rates by 50 basis points and have sort of hinted that they anticipate that they will be making more interest rate reductions in the future, possibly another two this year. On the inflation front, we're starting to see that begin to ease as well toward the Federal Reserve's ideal rate, which is 2%, is what they target. It eased to 2.4% year over year. However, I do want to caveat that, of course, we've seen tremendous inflation over the past 3-4 years here. It peaked in June of 2022 at 9.1%. And cumulatively, prices or inflation has gone up over 21% over these past 3-4 years. So still seeing tremendous amounts of just impacts for the everyday American and for everybody overall, because it increased food prices, increased fuel prices, gas prices, increased housing costs. All of those things have a tremendous impact on the daily lives of everybody. So it's something that we're still seeing. So it's been a very interesting year so far, but there are some positives that go in there as well.
Yeah, yeah. So just to reiterate that last item you spoke to on this slide, it's so important because yes, inflation has eased to that 2.4%, but actual prices are still much higher than what they
Yeah.
were several years ago or pre-COVID. So, progress has been made, but this is still a point of contention amongst everyone, especially, in talks leading up to this election, is as to how our government is going to continue to address this. Okay, so let's talk about how the markets have actually performed. The reason why we wanted to highlight some of the events or happenings of this year, not just in America, but around the world, is because the markets respond to that. So, in addition to that, of course, we're in an election year. So, Scott, talk to us about what we've seen so far from the markets in this election year.
Yeah, sure, sure. I mean, that's a great question, Christina. One thing we can say, and for this, we're going to be using the S&P 500 as sort of the proxy for the total stock market. I just want to point out that obviously the S&P 500 is not the total stock market. It doesn't include small cap companies, many mid-sized companies, and even some large companies. So just keep that in mind as we're going through this, that is what we're looking at, is just the S&P 500 as our indication of how the stock markets are doing. And then I'll also point out that the stock market is not the economy. While the stock market may be reflective of how the economy is doing, it is not the sole measure that we use to basically determine how the economy is doing. So there's many different measuring sticks that the analysts use, and the stock market is just one indicator of how that looks over time. So going to the S&P 500, as of through the end of the third quarter, so September 30th, it was up over 20%. If you look at it, even now going into where we are today in October, we're up over 22% in the S&P 500. So the market has done exceptionally well this year so far. All the other classes have done well, done good as well. So we've seen small and mid cap equities doing well. International has been a little bit of a laggard, but has still been doing decently this year. And of course, on the fixed income side with government bonds and corporate bonds, they've done fairly well given the situation, or given the environment that we're in right now. So they've all performed solidly throughout the year. But definitely the leading side of things is the large cap side of the world, and the S&P 500 being representative of that.
Okay. All right. Thank you, Scott. So these are some of my favorite slides. Let's see here. Oops. Sorry about that. This is so interesting. Scott, why don't you just tell us what this is telling us?
Yeah, sure. So this is the performance of the S&P 500 from 1933 through the end of 2023, and investing $1,000 over that period of time, and how it would have performed if basically throughout that whole period of time, if through all the different presidencies. So blue is obviously represented here by Democrats, and red is represented by Republican. And the general theme you can see here is that no matter who is in power, the markets seem to continue to march forward and upward. And that's something to keep in mind. The markets do not seem to be, they are agnostic to really who's in power at the time, especially in the role of the presidency. If the markets continue to do well, there's been very few times within this essentially almost, what's that, 1933 through now. I mean, we're talking almost 90 years of returns where pretty much the market has done very well over those presidencies, with the exception of maybe just once or twice. But even if there are downturns, which you do see here, of course, that there are downturns in the market, the overall theme is that generally you're going to see the markets continue to perform no matter who's in power.
Yeah, it's so true. And, the reason why I love looking at this slide and the next couple is because, Scott, both you and I have gotten so many questions recently, over the last couple of months about, given the election and depending on who wins or not, what should we be doing in my portfolio? And that's a very reasonable question to ask. I think that this chart and the next couple help tell the story of, what our answer typically is, which is just based on who is the president, we're not going to make any changes. That would actually not be prudent to do so. Of course, it doesn't mean we're not doing anything in the portfolio, but to make a change or to make an overhaul, just because one candidate over another might win or does win the election, that would be more so a knee-jerk reaction, which is, as your advisor, absolutely what we try to avoid. So,
Great point.
you also mentioned, a couple of downturns, and of course we see downturns all throughout these years. I want to reiterate, I think what you were trying to get to is downturns specifically associated with a change in party that is in the Oval Office. That is more so coincidental.
Correct.
It's not really causal. The reasons behind those one or two downturns that you might see in conjunction with a change in color in this chart actually does not have to do with who took over office. So
yeah, great point. I mean, the best example of that is if you look at the Bush years between 2000 and 2008, of course, we had sort of the dot-com bubble that burst there, but then the really horrible thing of September 11th happening in there. You see that dip sort of toward the front end of that. And then at the end, you had the 2008 crisis that happened. And again, that's not caused by the president. That's just happens to be what happened during that particular period of time. And you can see the same thing at the tail end here in the end of basically 2020. You see there's a dip there, and then it starts to go back up again as we move out of COVID. So
right, exactly. Okay, so on the same theme, let's look at the next slide here. Scott, why don't you tell us what we're looking at?
Yeah, this is a really neat one. This shows, so let's say that you decide, okay, well, I'm only going to invest when my preferred candidate is holding the presidency. This shows if you would have invested $10,000 in 1950, how it would have performed if you invested only when a Republican or a Democrat were in power. And if you just leave it alone and don't make any decision based on who's in power, how that investment in the S&P 500 would have performed. It's very clear here that moving in and out of the market based on who happens to hold the presidency is not the wisest move historically. Certainly, there's going to be changes and different ideas that will be put out there by presidents and different Congresses, but overall, long term, you're going to be better off being in the market rather than trying to time the market.
Yeah, I think this is such a powerful chart. And one more thing I'll point out about this chart. So the light blue line is representative of when you would invest only during a Republican being in office versus the blue line when a Democrat holding the Oval Office. And one thing I'll point out is it's a common thought that the Republican Party, their policies are more pro-business or pro-economy. And what you can see here on this chart is actually you would have done better investing only when a Democratic president was holding the Oval Office. Now, that does not mean I'm saying that the Democratic policies are better for our country. It's more so to further draw that comparison and that perspective that if you try to time the market rather than focusing on time in the market, there's going to be a huge opportunity cost, which you can obviously see compared to comparing those two blue lines to the orange line. So
yeah, excellent point.
All right, next slide, Scott, go ahead, take it away.
Yeah, this is another great graph. What this shows is obviously the blue side, again, being the presidency held by the Democrat, and the red side being the presidency held by the Republican. The interesting part about this graph is that it shows if the party in power holds both ends of Congress, so the House and the Senate, you typically see a little bit lower performance. The great part about this is that it actually shows gridlock is a preferred preference for as far as market is as the markets are concerned. So if you have a divided House, so the Republicans or the Democrats holding the Senate or the House of Representatives, you end up seeing probably in most circumstances, you see greater returns over time. But it just goes to show that it's really driven, really, there's more than the presidency or even just legislation or the legislature that determines how the economy is doing. But when the legislature is deadlocked, that ends up promoting an environment of compromise, which tends to end up leading to greater returns over time. And that's something that I think is really interesting in that you don't necessarily want to have total party control over all sides of the executive branch and the legislature.
Yeah, at least from the perspective of the markets, absolutely.
The markets, that's completely correct. Yes, without a doubt. So.
All right, so Scott, thank you for that background information. Let's move on to the actual proposals for these policies that both candidates have made available to the public and have announced. So let's start with Trump first. Talk to us about what he has communicated so far.
Yeah, I mean, what we can see with President Trump's proposals is that they're centered around extending the tax cuts that he implemented with the 2017 Tax Cuts and Jobs Act. We'll go into that a little bit more later. But his overall theme is that he wants to continue to reduce taxes, individual income taxes, and also extend some of the provisions that were part of that Tax Cuts and Jobs Act. He's also has put out there that he would like to eliminate taxes on certain items. You can see here that he's looking to exempt Social Security benefits from taxation, exempt taxing or tip income, and also exempt overtime pay from taxation. So those are three of his bigger proposals that he's thrown out there so far, which would be pretty big movers if that were to happen. And we'll get into a little bit too of the likelihood of some of this. But those are the basics of where he stands. His goal is to eliminate or reduce taxes across the board for all Americans. And that's really the overall theme for him. If we move to the next page, we'll look at capital gains. He hasn't produced any new guidelines around what he's planning to do with capital gains and dividend taxes. But the assumption would be is that he would continue to look to further reduce those across the board if possible. A big one is the estate taxes. He looks to continue to increase or allow those 2017 Tax Cuts and Jobs Act amounts to continue to increase based on inflation. That would be a goal of his. And then finally here we have tariffs. That's something that he's added on in here that really is something that's a bit different than what we've seen in the past from any administration, unless you go back to the 1930s. And that's imposing a universal baseline tariff on all U.S. imports of 10 to 20%, and levying a 60% tariff on imports from China, and consider replacing personal income taxes with increased tariffs. So those are some big ideas that he has proposed at this point. What I'm going to preface this with, and this will go exactly the same for President Harris, or Vice President Harris, is that this is a situation where these are proposals. These are not yet things that have gone in front of Congress to be passed into law. So these are sort of the wish list so far for the candidates. What's going to happen next year is that once somebody has been elected and Congress has sorted itself out, they're going to have to come up with a plan that may implement some of these, that may not. But right now, these are all proposals. All of these proposals potentially, say for Trump, there could be positives and there could be negatives associated with them, just the same as Vice President Harris. There would end up being positives and negatives associated with each one. But that's, again, just want to remind everybody, these are proposals. We don't know yet what will actually go into place.
Right. Okay. And yes, we are going to get a little bit more into the Tax Cuts and Jobs Act as well as tariffs, because those are such big talking points right now leading up to this election. So more to come on that. Let's move on to Vice President Harris's tax proposals. Scott.
Yeah, so for Vice President Harris, in contrast to President Trump, her overall theme is really reducing income tax rates on folks that are making or keeping income tax rates where they currently are for those making under $400,000 a year, and then targeting tax credits for those individuals that are making under $400,000 a year. So that's really where her difference is. Instead of decreasing taxes across the board, she's looking to target those to those making under $400,000 a year. And for those that do make over $400,000 a year, you're going to see an increase in the amount of taxes that potentially they would have to pay. So like President Trump, she has also thrown out there the possibility of exempting tips from income tax. Again, like President Trump, that would have to get through the legislation, which, I mean, she'll face the same hurdles that he would face if they were to propose that, if she were to win office. But the big thing here is that you'll see for her that she's targeting those through individual tax credits. So for child tax credits, earned income tax credits, housing tax credits, also Affordable Care Act tax credits for paying premiums. And then a big one for her was providing a $25,000 down payment assistance toward first-time home buyers as well. And I'll also throw in there that we've seen some additional things that have been proposed since this was put together by both Trump and Harris. And again, these are sort of last minute ideas that they've put out there. We'll see what can actually happen or get through legislation. But at this point, these are where we're looking at things going across the board. So let's take a look at the next page.
Okay.
Continuing that theme for her, she'd be looking to increase long-term capital gains rates for those that make over $1 million a year to 28%, and increasing the net investment income tax to 5% for those making over 400,000. So if you're making under 400,000, these particular proposals wouldn't impact you. So there's not too much concern there if you're in that range. For estate and wealth taxes, she has not stated anything specific about that, but the assumption is that she would be happy to let the Tax Cuts and Jobs Act reforms that were put in place. She would be happy to have those sunset, especially on the estate tax side. And for tariffs and trade, she has not proposed anything new there. However, I'd like to point out that for tariffs and trade especially, President Trump had put in some different tariffs, and President Joe Biden had also continued a lot of those tariffs. So there's a very good chance that she would continue some of the tariffs that were put in place under President Trump. But again, we would have to see what she decides to do if she were to actually win office.
Okay. All right. So let's get into tariffs a little bit. Scott, first, if you could just explain what a tariff is, how it works.
Yeah.
And then what I'd like to do is draw it back if there is a direct or indirect relationship to or effect on someone's portfolio, if there is that connection. So go ahead.
Yeah, certainly. The purpose of tariffs in general, and you can see it listed here, is that it's usually for many different items. Back in the late 1800s, early 1900s, it was actually used for revenue generation quite a bit. It's also often used for protectionism and also potentially retaliation. So if another country imposes tariffs on us, we may do the same thing. One thing I'll say with the way they've worked is that there's a couple different ways that these tariffs can actually be implemented. They can be implemented through legislation, which is passed as trade acts that allow these tariffs to be put in place. And there's also executive power. An example of this is that tariffs that were placed or put in place under President Trump were actually put in place through executive power. They weren't necessarily passed through legislation. In 2018, he placed a tariff on imported steel and aluminum. And the reason he did that was actually for wanting to have strong domestic production for national defense. So importing those like cheap steel from China or from Europe was something that he felt was hindering our businesses or our ability for national security to be able to produce the goods that we need to produce to protect ourselves. So he placed those under one of the trade acts that allowed him to do that for national security purposes. And he also placed tariffs on a lot of Chinese goods that were coming in, and he did that under the unfair trade practices portion of one of the trade acts that allowed him to put that in place because, hey, he's seeing this, they're putting goods into our economy that are subsidized by the Chinese government that are lowering the prices artificially. And also they have a lot of issues with intellectual property theft. And because of that, he wanted to place those tariffs to make US products a lot more competitive. So those are some of the ways that those tariffs can actually be implemented is through that legislation or executive power. What I'd like to do now is sort of take a step back here and give you an example of what this actually looks like in true form. So how do the tariffs work themselves? So the example I'm going to provide here or give you is for a Sony TV. So everybody's familiar with Sony and the fact they're a Japanese company, they import TVs into the United States. And so let's sort of walk through how that works. So Sony itself, again, Japan-based company, they actually have a division in the United States, Sony North America, that is actually based in the United States. So what happens is that when Sony wants to sell a TV in North America, they transfer that TV to Sony North America. And Sony North America is the importer of that good. So Sony North America, we're going to say that there is a 20% tariff on the TV that's coming in. The TV that's being sold is $500, and that's the cost of the good for Sony. So the US based Sony is taking that $500 TV, and now they need to pay a 20% tariff to the US government. So in this example, that's $100 that would then be forwarded for each TV to the United States government. So that tariff is paid by the importer. So whether that be Sony, in this example, Sony North America doing the importing, or if it's say Best Buy or some other company or grocery store or whatever it may be, they're the ones, if it's being imported from outside of the country, they're the ones that are actually paying the tariff itself. So in this example, again, we have Sony having the TV that they paid $500 for, and there's now a $100 tariff. That $100 tariff, the price of that, there's a couple different things that can happen. So the TV itself at retail price is, let's say, it's selling for $1,000. So Sony can choose to say, okay, we're going to take that $100 tariff, and instead of charging $1,000 for the TV, we're going to now charge $1,100. The other option would be, hey, we're going to accept the full load of this tariff. We're not going to charge that to the end consumer. So we're going to continue to keep that price of the TV at $1,000. Or they could choose to go somewhere in the middle. They may say, okay, we're going to take $50 of that tariff. The consumer is going to need to pick up $50 of that tariff. And that's how they move forward. It really depends on how they want to pass that along. They can choose to pass it along to the end consumer, which is often how most of these tariffs will work, is that the end consumer will see an increased price on the good. But that is the choice of the importer and where they need to be as far as being able to make the sales that they need to make in order to move forward. So it's very interesting how it works. Again, there's not a set definition of how those tariffs will be passed along, but often it does mean that there will be increased prices to the end consumer.
Okay. All right, Scott, thank you for that. So the last question I want to ask regarding tariffs, what you just ended that with is the result that tariffs can have on an individual's cash flow, right?
Yeah.
When they're purchasing goods. And what I'd love to know is there any direct or indirect, connection between tariffs being implemented and in someone's portfolio, someone's investments. And now you and I, obviously, we've talked about this. And so the conclusion we came to is there's no black and white answer, right?
Yeah.
What actually happens is variable. However, what we did discuss there are different components that can have a positive effect versus a negative effect on a company's pricing and therefore, an individual's portfolio. And when I say a company, I mean a stock. So why don't you talk us through those components, rather than trying to give that black and white answer, which we know there really isn't when it comes to
Yeah.
tariffs.
No, great point. I mean, the one thing with tariffs is that many times what will end up happening, and this goes for any goods that are subject to tariffs, is that for the U.S. side of the house, often it's used to help incentivize or protect U.S. companies in order to increase production here. So what that will generally mean is that if there is a tariff on a good that's coming into the U.S. that has a U.S. Manufacturer and they're competing against that company that's importing the good, that often will mean that the U.S. product will now be possibly a preferred choice because it's either less expensive or they're able to purchase those U.S. goods. And that has an impact on U.S. based companies, of course. So you'll see an increase potentially in sales and in profits, and that will obviously reflect in their individual stock prices as well. So thus in your portfolio. The downside potentially to that is that if we did impose that tariff, the opposing country could come back and also put a tariff on goods that we're exporting outside of the U.S. to those other countries. Obviously, many of the large companies that are in the U.S. are doing business all over the world. So that could have an impact on their earnings as well all over the world if they're not only selling into the U.S. So that's something that certainly can happen. And it really depends on how that tariff is passed along and if there are any retaliatory tariffs that are placed on U.S. goods if they are in that situation.
Okay, thank you. All right, so let's move on to the Tax Cuts and Jobs Act, law that was passed under President Trump, potentially sunsetting at the end of 2025. Let's talk about this, Scott.
Yeah, this is a big one. So as Christina just said there, at the end of 2025, if nothing is done and Congress doesn't get anything passed as far as new legislation for taxes, at the end of 2025, the Tax Cuts and Jobs Act will sunset on January 1st, 2026. We're going to see increased taxes. So what that means, as you can see here, we sort of break it down again into individual income taxes. For that lowest tax bracket, 10%, there's really no impact at all. However, for the next income tax brackets, you're going to see some fairly decent size increases. So currently there's a 12 and a 22% tax bracket. Those are going to end up getting bumped up 3% if the law sunsets. The 24% tax bracket will increase by 4 percentage points. And the 37% tax bracket will increase by 2.6 percentage points. So there will be a large increase in individual income taxes, or a fairly large increase in individual income taxes across the board for all involved, if nothing is done in order to pass legislation to either continue or modify or do something with the original Tax Cuts and Jobs Act. On the capital gains and dividend tax front, the only thing that will really be impacted there will be short-term capital gains and dividends, since those are taxed at those ordinary income tax rates. So those would see increases as well. Obviously, just as a reminder, short-term capital gains and non-qualified dividends are those that are realized if traded within or under 1 year or held for less than 1 year. So as long as you are holding those assets or those investments for over a year, you're not going to be subject to the short-term capital gains.
And I'll just interject there because
Sure.
I imagine maybe some folks who are watching who are clients of Apanowitz might be wondering, well, how much in short-term gains do I have? The typical client has very few, short-term gains at one particular time or another. So, however, if there are short-term gains in your portfolio, that is something that your advisor will be proactively addressing, with your CPA, if that becomes, I guess, an issue, for lack of a better word, in the event of this law sunsetting.
Yeah.
Sorry about that, Scott. Go ahead.
No, great point. I mean, again, the majority of the gains that we see in most client accounts are typically long-term capital gains, but there are always those exceptions where we'll see some short-term gains here and there.
Mhm.
For the estate tax front, there's a big difference in what's happening right now. For single individuals, you can have up to $13.6 million of assets and not be subject to estate taxes. And that was passed under TCJA. And for married couples, that amount goes up to 27.2 million. Those are indexed for inflation each year, so they're going to go up again next year. I believe it jumps up to, I think, 14 million, close to 14 million for next year, and 28 for couples next year. But those are set to sunset, and they will be cut in half. So what they're expecting is that if it does go into effect or does sunset, that the single individual amount will drop down to 7 million. And for couples, that would drop down to 14 million.
Mhm.
So that's a very large change in the amount that would not be subject to estate tax. And just to give everybody sort of a reminder of how the estate tax works, let's say today, again, it has to be 13.61 million before you have a problem with estate taxes. So let's say that you actually have $15 million, you pass away. What actually ends up being subject to the estate tax is just that difference between the 15 million and the 13.61 million. So roughly 1.4 million there is subject to the estate tax, which is set at 40%. So 1.4 million would be subject to estate taxes, not that 13.61. All of that up to that point is exempt from that. It's just that amount that's over that amount that is subject to the estate tax. And finally, here on deductions, the standard deduction is scheduled to also sunset back to roughly half of what it is now. Currently, it's set at $14,600 for a single individual and $29,200 for married filing jointly. That amount is increased if you're over age 65. There are some additional amounts that get added onto that. And those are set to decrease again by roughly half next year. However, with that, they are bringing back what would come back would be personal exemptions and the availability to itemize additional items that currently cannot be itemized based on the original Tax Cuts and Jobs Act law.
Okay, thank you, Scott. Yeah, just to round this out on this slide, at Apanowitz, clients would know this, we implement what we call the seasons of wealth management, which allows us to be intentional and organized about addressing every facet of your net worth, not just your investments. The investments are our focus every day. However, the estate planning and the tax planning and insurance and risk management, it all works together. It's comprehensive. And so I say that because right now we are in that, what we call that third season of wealth, where we are reviewing things through the lens of taxes. So this is actually something that we are internally, at the very least, starting to discuss quite a bit, and looking at what proactive planning strategies can potentially be taken advantage of in light of this law potentially sunsetting at the end of next year. Now, that being said, it's still unclear what exactly will happen. And on top of that, what might make sense for one individual doesn't necessarily mean that's going to make sense for the next individual. So the planning and the approach to preparing for this potential sunset will need to be customized, to each individual. But that being said, this is something that your advisor will be proactively discussing with you. If not this year, throughout next year, absolutely, especially when we know who will be taking office in January And it's something that we will be reaching out to your CPA or accountant, if you work with one, about as well.
Yeah, great points.
Okay, let's move on to these income sources. So, whether you're retired or not, but we're focusing on typical income sources that a retiree might see. Those different income sources are taxed differently, and some of these could very well be affected by these proposed tax policies that we just discussed. So we thought it would be helpful to just review in general how those different income sources are taxed. And also what I'll say is, and Scott's going to go into this in detail, but when you have a diversified tax situation, meaning you have several different income sources and they are taxed differently, that is potentially a great opportunity for some tax optimization planning. So, this is something that you want your advisor and your CPA or accountant to be working together on proactively. Is every year, especially, at this time of year, we are reviewing those income sources with our clients. Even if we already think we have an idea of what those are, we review those income sources intentionally to make sure that we are aware of every potential income source in each one of these boxes here. So Scott, take it away. Why don't you explain to us how all these different items here are taxed?
Yeah, sure. So obviously we can see here 401ks, traditional IRAs, and pensions. Those are treated as traditional ordinary income. So all of those discussions we were having about the individual tax rates sunsetting, all of that would be impacted because those are that's considered ordinary income. And so you also see here that banks, savings, Social Security, part of that potentially is taxable as ordinary income. And basically income from annuities can be considered ordinary income or are considered ordinary income as well. There are some different types of annuities that are out there that can allow for some of that to sort of be deferred, so it might not be recognized all at once. But again, when it does come out, typically you're going to see that being taxed at an ordinary income tax rate. For capital gains and dividends, those are obviously taxed at the short-term or long-term capital gains rates. For long-term capital gains rates, it's sort of bracketed out up to certain levels where you can see a 0, a 10%, I'm sorry, or 0, a 15%, and a 20% tax rate for long-term capital gains. And for a short-term capital gains, again, that would follow the ordinary income tax bracket. And then finally, Roth IRAs and Roth 401ks, those are generally going to be considered tax-free. There are some caveats around that. Again, just making sure that you're not pulling out too soon or doing certain things. But in general, the distributions when you're in retirement for the Roth side of the house are going to end up being tax-free.
Okay. All right. Thank you, Scott. All right. So what should we do and what should we not do, Scott?
Well, as we've seen throughout the year so far, I think we can definitely take into account, or we want to make sure that you are prepared for volatility. We're still a couple weeks away from the final election day, and there's going to be volatility that's going to occur between now and then. And I would fully expect that there's not going to be a winner immediately declared. It will probably be a week or at least a couple of days before we know who the actual final winner is. So just be prepared for volatility. The markets will react to that. But remember that volatility is typically short term. And then once something has actually happened, as far as who is the winner of the contest, you'll probably see the markets bounce back no matter which one it is. If there is a downturn during this period of uncertainty. So just realize that there's a good possibility that you will see volatility, and try not to focus on that. So that goes to the don't side of the house is try not to make decisions based on what we're seeing in the news right now, what we're hearing from candidates, what we're hearing from pundits that we listen to on TV. Try not to let that sway how you're looking at your investments and how you're looking at your portfolios. Think about it from the long term. What are your long-term goals? Where do you see things? Because if you do make decisions in the short term, that could have a tremendous impact on the value of those investments later on down the road by not being invested in the market. So that goes to that second point. Do focus on timing the market, not trying to time the market. just make sure that you're keeping that in mind. This is a short-term thing. The markets seem to be fairly agnostic to which president is in power as far as the party is concerned. So long-term, the overall theme is that you will see, hopefully, markets continue to march on and continue to improve. Don't focus on those day-to-day fluctuations. That's something that can drive you crazy. And we speak to a lot of clients, and it's perfectly fine if you like to look at your accounts on a daily basis, but try not to focus too much on that and be too concerned, because again, look at it from the long term. How have we done year to date? How have we done over 5 years, 10 years? How have things performed over that period of time? Try to look at it from the long view rather than just taking a look at it from a day-to-day view. Take advantage of certain tax planning opportunities. We're going to talk a little bit about this, I think, at some point, but there could be opportunities for utilizing different techniques that could be beneficial now, that are opportunities that you should be looking at. And that's something that, whether it's you're with Hapanowitz or you're looking at another or working with another advisor, they should be able to bring those ideas to you. And that's something that we can share with folks that have those questions about different types of opportunities based on what their current situation is. Review your portfolio allocations to ensure risk tolerance and diversification alignment. So what that really means is know what, if you are a client of Hapanowitz and you've put something in place, or that you made a decision that this is sort of how I feel as far as risk tolerance is concerned, make sure that's still in alignment with what you want. Maybe you need to be more conservative. Maybe you need to look at a different direction. However, I mean, we're going to have those conversations with you on an individual basis and determine, is what you have decided on as far as risk tolerance prior, is that still in alignment with what it is today? And are there any changes that need to be made? And if they are, then we certainly can have a conversation about that and take a look. Be aware of the short-term income needs. So if you do need cash, make sure that you're planning for that, and make sure that you do have those assets set aside to be able to access as you need. And of course, work with your entire team of advisors. We work closely with many of the CPAs and attorneys that work with our clients. And we encourage you to communicate with all of us whenever there's a change. And that goes to that final point on the don't side, is don't forget to inform your trusted advisors when you do make changes. If you're working with an attorney or CPA and you have to make a change into a way that maybe you're receiving income, or you're making a change to your estate plan or something like that, those can all have an impact on your financial plan. And it makes sense to go ahead and include all of the folks that are involved in your all of that, to be included as far as just keeping us in the loop. Christina, would you add anything to that?
No, you covered it, Scott, really well. I'll just reiterate, it's we find it to be so important and essential that all the advisors are in communication with each other. And I think those watching either live or the recording, if you're a client of Hapanowitz, I think you know that, right? We are proactively reaching out to those individuals throughout the year, because it does all work together. There's no sense in doing a great job here if it's not going to work, fluently and comprehensively with the other things you're doing for your legacy and your wealth and your family.
Yeah.
All right. Thank you, Scott. So, before we move on to questions, something we wanted to offer, especially to those who are not yet working with an advisor, maybe wanting a second opinion, about what they're doing, please reach out to us. You can either call us at our office, 412-261-5966, or you can go to hapfinancial.com/review. That's HAP financial.com/review. Submit your information and you can get in touch with one of our advisors, where you'll have a consultation complimentary to you, and they'll give you some takeaways, basically a plan and their observations and recommendations on what you're doing versus what they might suggest you could do to work closer towards your goals. especially in light of so much volatility and so many, events and happenings that we've been seeing throughout this year and inevitably will continue to see in the future as well. And if you're already a client, of course, your advisor is in touch with you often, but you can still reach out. You can still click on that link and get in touch with your advisor that way, or give your advisor a call if you'd like to get in touch with us after this webinar, especially if you have any questions that have come up from this. So that being said, let's answer a couple questions. Like I said, there were several questions that were submitted ahead of time, and we will answer 3 of them. Right. Okay, so let's move on to the first one. It says, where do you see interest rates next year? And how are you managing for interest rates in my portfolio?
Yeah, that's a great question, Christina. Of course, the Federal Reserve has indicated that they're planning to continue to reduce interest rates in the near term. They're expecting potentially another 2 cuts this year. For next year, they haven't said for sure if they anticipate on keeping to reduce or continuing to reduce rates. But in order for them to aim for that 2% target of inflation and also maintain stability in the labor markets, the assumption is that they will continue with potentially trying to continue that easing of interest rates and continue lowering that into 2025. So it really will depend on where things sort of fall out, especially on the labor market side. That's been more driving it since inflation is getting more in line with what they've traditionally been aiming for. And as we continue to approach that 2% rate, it'll really depend on the labor markets and other indicators to determine if they're going to continue that rate easing. As far as how we look at that or how we'll approach that or how we've approached it so far, even this year, we try to make decisions based on how we manage rate sensitive portions of your portfolio. So for those fixed income portions of your portfolio, we've been extending the duration or the length of time that of the different treasury notes and bonds that we purchase. So in our fixed income portfolios, generally we have a fair amount of treasury bonds and treasury notes. And previously we had been going to the shorter end of that because honestly, prior to the rate cuts, the rates were very high and were looking very strong, and there was no need to go out a longer duration. So going out longer terms. We've taken the approach now where, because we've seen the rates starting to come down, we're extending that duration out in order to maintain a higher percentage or getting a higher return from those particular treasury notes and bonds that we're utilizing within the portfolio. So we are taking a look at it on a very frequent basis, and we'll continue to make decisions as rate cuts continue to happen over time, and make adjustments as needed as we move forward.
Thank you. All right, let's move on to the second question here. What are some planning strategies I can do if the Tax Cuts and Jobs Act sunsets in 2025?
Yeah, there are a couple really big ones to consider. I can't go into all of those. There's a lot of them. But the 2 big ones that most people will have heard of or at least heard something about, one would be Roth conversions. So taking a look at potentially doing Roth conversions, and if we anticipate or we see that ordinary income tax rates are going to increase in 2026, that might be something that we say, okay, now might be a good time to do this because individual income tax rates are going to go up next year. So maybe you want to accelerate, if you're already doing Roth conversions, accelerate and maybe include a little bit more or do a little more, or potentially actually add Roth conversions as an opportunity. That is something that we coordinate closely with CPAs and accountants on, because we won't tell you exactly how much to do. We work with the CPA or accountant to determine what's the appropriate amount based on your current income levels and how much can you comfortably afford to do, and not increase your taxes any more than they need to be. So that's something that we work closely with them on. But that is something that for Roth conversions, we definitely take a look at, and we want to make sure that we're paying attention to this year and into next year. So if you're doing those, have a conversation with your advisor and see if it's something that maybe you want to increase, and that's where we'll bring in the CPA and accountant to see if that's appropriate for you. One additional thing I would say is that for different ideas is really thinking about accelerating gifting and looking at different ways to pass along assets that you may already be doing. That includes gifting to, family members, loved ones, charitable organizations. One way to reduce taxes is make sure to consider like qualified charitable distributions. If you aren't taking RMDs yet, that's something that you can do with your IRAs. If you are taking RMDs, that actually the qualified charitable distribution, if you are taking RMDs, will allow you to basically offset the RMD amount by the amount that you pass to the charitable organization. So let's say that you have an RMD that is $20,000. That's what's required this year. You're going to take $2,000 of that and donate it to your church. So $2,000 of that 20,000 goes to the church. And now your taxable amount for that year is $18,000. So that $2,000 of qualified charitable distribution ends up offsetting that amount, and now you just owe taxes on $18,000. So that $2,000 amount is completely tax-free to the church, and your income for the year is reduced by that same amount. So it's a great way to utilize those as a potential option. Would you add anything else, Christina, on that?
Something that we have talked with clients about over the last couple of weeks actually is if their main source of wealth, of liquid wealth, is their retirement account, and therefore their main source of retirement income is the IRA. And as you've mentioned a couple times now, IRA distributions are taxed as ordinary income. Mm-hmm. If we know, or if the client lets us know that they're going to want to take a larger one-time distribution that's not ordinary, on top of their regular monthly distributions, then we might be suggesting that they think about accelerating that distribution to happen, or at least a portion of that distribution to happen prior to this Tax Cuts and Jobs Act sunsetting, to, again, take advantage of the lower tax rates currently. Even that's really independent of the Tax Cuts and Jobs Act, though. Yeah. If you know that a big expense is coming up, sometime next year, and we're relatively close to the end of this calendar year, then yes, we have suggested to clients, perhaps think about taking a portion out this year and then the rest out next year. And that way you're separating out that tax bill over 2 tax periods. That can be a good tax planning technique.
Yeah, so that's a great technique, and it makes a lot of sense for folks that do have large expenses that they have coming up into 2025, and consider splitting it up. That is something, and that's something you can bounce off of any of your advisors at Hanowitz, and we can have that discussion.
Yeah, I would say if you're not sure if your advisor would care about something, just tell them, because you would be surprised at how impactful that information can be, and how we might be able to help maximize things or save on taxes. So even if it doesn't seem like it's an update that's necessarily directly related to your investments or your portfolio, or if I'm asking one of my clients a question and it might seem a little nosy, it's not because I'm trying to be nosy. It's more so we're trying to have that better awareness of what's going on in your life, so that we can help on our end. So yeah. All right, let's move on to the last question that we'll take today, or that we'll answer today. It says, what types of income sources are flexible in terms of when they are received for tax planning purposes?
Yeah, that's a good one. What I'll say is, again, there's a couple different sources that we could discuss. I'll focus on the ones that are primarily related to retirement. But clearly, IRAs do have some flexibility with that if it's prior to beginning RM required minimum distribution. So if you're prior to currently, if you're under age 73, you're not required to take distributions. But you could, during these years, if you're under age 73, you could choose to start taking distributions now instead of waiting till required minimum distribution. Especially because that gives you the flexibility of if we're in a lower tax environment than we may be at beginning in 2026, that may allow for you to pay less in taxes overall over the long term.
Mhm.
Something, again, that will be a conversation you have with your advisor and your CPA to see if that makes the most sense now. Because continuing to defer as long as you can in an IRA is never a bad thing, because again, the compounding effect is a beautiful thing and we want to see that happen. But that is a one way or area for flexibility. Another would be capital gains and when you recognize those. It can be targeted of when you recognize those, when something is sold. So if we're at a point where, okay, we know that a capital gain, you're planning on selling something, that might be, well, we wait until next year to do it instead of doing it this year. So there is the possibility of extending that. But obviously, if there are any cases where you've held an asset for less than a year, it may make more sense to wait until at least a year in order to qualify for long-term capital gains rather than the short-term capital gains. So there is a lot of flexibility on non-retirement assets of deciding when you can recognize those gains and how that can impact your taxes now. So.
Mhm. Okay. All right. Well, those are the questions. Thank you so much. Thank you, Scott. And
Yeah.
thank you, everybody, for tuning in today. We hope you found it useful. Again, if you think of any questions from this presentation, please reach out to us anytime. Our emails are on the screen. You can also give us a call as well at the office, 412-261-5966. And we will see you next time. Thanks, everybody.
Great. Have a great day, everyone.